Hey everyone, it's Justin again with Confident Options. Tonight we're going to review trades closed on 8/2/2018, August 2nd, Thursday. So before we jump into it, of course, if you guys head over to confidentoptions.com, you'll see all of our past 30 days of trades. If you go to the Performance tab, Close Trades. On this page here, like I mentioned, starting with the top, you'll see the most recent trade all the way down through the past 30 days, and we kind of cycle that on and off. I mean, we take trades off and add trades on, and it's just a great place for you guys to see kind of our strategies and what we do. So let's jump right into it. The first trade we closed today was our call credit spread in United Airlines, UAL. On this one, the indicators were signaling to us that the stock was ready for a either a stall or a reversal, which is exactly what we got. So you can see after the earnings move here, zoom in a little bit. This is the 1 year chart, so we were at highs, 1 year highs. Zoom in just a touch here. So after the earnings event here, gapped up, was really strong, and then continued to push. So it kind of pushed for 5 days in a row, and then it kind of started phasing and falling off. Our indicators didn't signal until this day here, this red day, and so that's when we entered the trade. And what we ended up taking was above the market, the 85-86 call credit spread. And so for those of you that are new, that means that we sold the 85 call. So that would fall right about here, right between these two strikes. And we bought then the 86. So our spread was only $1 wide. We made money as long as the stock from here stayed under our short strike. It could go up, it could go down, it could go around, it could crash. Anywhere in there, we make money. So that's the beauty of these spreads. We love them. See, these are both calls, and that's why they're called vertical call spreads. Selling the one closest into the money and buying the one right after that, one strike out at the 86. So we ended up collecting about 25%. 25 cents. A good rule of thumb is that you want to always capture 1/3 the width of the strikes. So in this case, for fair pricing, we should have collected about 33 cents. We only collected 25, but we know that the indicators are on our side here, meaning that it's bound to either slow down or turn around in the next 45 days. And so when we back test that, we win pretty close to 100% of the time. You don't collect a lot of premium on these trades, but they're good for your overall portfolio. You want to keep cycling in and out of your premium in your capital. You want to put it to work and bring it back out and take your profits and move on to the next. So that's exactly what we did here. So going back over to the trade tab, again, call credit spread, sold it out 31, the expiration at the end of August. We only held it for 9 days and we captured 40% of the premium. And we returned almost 13.5% on our capital, which was fantastic. So one contract of this trade only cost $75, and we returned 10 on that one contract. So you can scale up from there depending on the size of your account. But even you can tell here, even $1,000 accounts could make a nice return on their overall account just with this one simple trade. So in on the 24th, out on the 2nd, sold it for a credit of 25 cents and bought it back for 15 cents, closed the entire thing. So moving on, we had another call credit spread, this time in EWZ. Again, the indicators were showing this one was ready for either a return around or kind of a stall. And that's exactly what we got. So what has happened in this ETF is the Brazil ETF. It's just been tanked. It just got slow grind down. Our indicators, we had a put credit spread, which would be the other side of this trade, which happened. Our indicators, I think, signaled down here. After all this time, we finally got our signal down here. We took the trade, we took our profits off, and now we're signaling on the other side when it got up in here. So on the, let's see when we enter this, 725, we entered this trade. So let's look what the stock was doing on 725, or the ETF here. So 725 was this day here. So big time pop up here, gapped up every single day. And so that's where we entered our trade. We love to do these into strength, especially after a long run like this. And so we did it on this candle here. And what we ended up doing was selling the 40 and buying the 42. So again, same technique as our last trade, where we want to We want to sell a call put above the market. So we gave ourselves a ton of room all the way up here. That was the 40. That was our short strike. And then we ended up buying the 42. So this time we had a $2 wide spread, so it's up here even further, 42, and we bought that. So that caps our potential loss, and that makes the trade risk defined. So we had the room from here for the stock to move up if it wanted to, come back. It could move back up and move back down. As long as it stayed under our short strike, we would have profited on the trade. It just so happens that we got a nice move lower, and so we were opportunistic when it opened lower today to go ahead and close off the trade for a great profit. So looking back at our website summary, we sold again the 40, bought the 42, and this should be a call here. I'll get that fixed so I don't want it to confuse anybody. That's a 42 cent credit, and we bought it back for 23 cents. So we captured about 45% of the premium, and we returned almost 12% of our money. So again, 2 trades in a row where they didn't require a bunch of capital to get into, and they returned quite a bit on the capital that you put to risk. So again, scale this up for the size of your account. We just show this one example just for everybody's kind of knowledge and simplicity of making it just one contract. So that way, if you have a larger account, you can say, well, I could do 10 contracts, or if you had a smaller account, I could just do the one, and this is what I would return. MGM, this was our earnings trade, one of our 2 earnings trades. We're currently working on a clever way to kind of display this information each night when we go into earnings evaluation. And this is where we're at so far. I'm not sure if this is going to be our final product or not. But what this is doing is these blue bars represent the expected move. So when the market makers price in the move, we calculate how much that expected move is going to be in a percentage. The red step graph is the 1 standard deviation move of all previous earnings events, and the yellow is 2 standard deviation moves of all past earning events. So that means that Tesla, in the past, 95% of the time, that's what this represents, 95%, it's moved under whatever this percentage here. We'll call it 16%. It's not quite halfway. It's a little above. So 95% of the time, it's gapped or moved after an earnings event, under 16%, 16% or less. So that's what this represents. So what we're looking for, and then the green line here is just the number of occurrences. So this has been 30 different earnings events. So we want the number of occurrences to be super high, that we were confident in our standard deviated ranges. Except, it's hard if this square down here has only had 10 earning cycles because it's a relatively new stock, so it's hard to have a ton of confidence in the data that we're looking at. But when they have a ton of occurrences like here, that gives us a lot more confidence in the numbers that we're looking at. So what we're looking for is that the expected move, blue bar, is greater than the 1, and it's a bonus if it's greater than the 2 standard deviation move. So that occurred right here, APA, and that also occurred on MGM, it was greater than its 1 standard deviated move. It was really close on Win. Win would have been worth a shot. It would have been a winner, but you can see nothing else, nothing else even came close. T-Mobile came a little bit closer than some of these other ones, but some of these other ones, just what this means to us is that the pricing is not rich enough to outweigh the risk involved in the trade. We've done a ton of earning trades, and when you get burnt on an earnings trade, sometimes can last for months because you're rolling out and defending. It takes a long time to get that capital back, and so we always want to be very selective on the trades we take, and this is the evaluation that we do. So we're looking to roll this out either in like a newsletter or on the site every night. That way you can see what we're looking at and what we're trading. So the first one, MGM. Let's jump into the charts. So kind of some weird stuff going on in this stock. I don't know if it's just general with the entertainment or gambling industry, but the day before earnings, they sold off pretty hard. The earnings hadn't even announced yet, and it was selling off pretty hard. And so it ended up closing down here at 28.55. What we did was sell a strangle at 31.50. So up here at 31.50, and then we also sold the 26.50 put down here at 26.50. So it opened up way down here, really close to our 26.50 put side, but it never breached, and it actually ended up coming all the way back. Our testing and our experience tells us to close these as soon as possible, so we always do. If we would have let this hang, it would have been a nice solid winner. It ended up closing right in the middle of our range. We would have had a nice IV crush here. Everything would have lining up for us. We would have had a nice profit, but we stay disciplined, and we always do, and so we close it right at the open. And so this one was a wash, which is absolutely fine. I'll take a wash any day of the week. That's a beautiful thing when it comes to earnings trades and you don't exactly get it right. Even though we get it right, it can be frustrating. But some of these, they don't decay as much as early, and so we end up, taking a small loss, which is totally fine. And so what we did was sell again the 31.50, 26.50 for 44 cents. We ended up just buying the 26.50 put, the challenge side, for 44 cents. Got our capital back, didn't lose any money, and moved on to the next. And so that was our MGM. The other one, if you remember the graph, was Apache, which was actually the best looking trade going into earnings. They were pricing greater than 95% of the past earnings move. So we went a little bit heavier on this one, which is obviously because of the research that we've done, so we feel confident in that. But what we ended up doing was selling the 47, 42.50 strangle. So let's look at the chart really quick. This is the last trade. A busy day for us. So here's the close before earnings. So it closed at about 44.92. We'll call it 45. And so what we did is trade the 47 call and the 42.50 put. Somewhere in there. These are a little bit smaller. But the expected move, if we go back to our research here, the expected move of Apache was only $1.86. Okay, so that gives you some idea about how much this stock has historically moved in the past. It's a pretty big market cap stock. It doesn't move a ton, so that was a big range for this type of stock. So what we did was sell that for 53 cents. As you can see, it opened up like a 60 cents lower, which was incredibly awesome for us. It was right inside the range. We got a nice earnings crush, which is what we're looking for. So we closed the trade right away, like we always do, sticking with our rules. And so we closed it for 29 cents, captured about 45% overnight, and returned 3.5% our capital. We loaded up on this one because it met that criteria of our research, and so we were super stoked to see that it opened where we wanted it to, pretty much. So we had 3 earnings trades going into the close tonight. We'll recap those tomorrow and see how they go, as well as any other closing trades. For now, I'll wrap it up. Thanks, everybody. Have a great night. We'll talk to you tomorrow.